I think David Kelly and others in the market will be disappointed that we don't have that number that they're aiming at, but they're aiming for a number that is above the 2% target in order to achieve average inflation. This is a moment that I didn't think I'd see, plus the idea that now the policy outlook is for 0.1% into 2023, and I do see 1, 2, 3, 4 hikes now in the dot plot for 2023. But that means that I believe 13 are at 0.1 or between 0 and 0.25. So there's one hike built in for 2022. I don't know how you get more dovish than that, Tyler. I don't know what else you could do.
David
Kelly, go 5 years at
David Kelly a moment ago said he expected them to continue cooing. David, this sounds like coup.
It's a deafening amount of cooing. Yes, I think that this is a very, and you know what, it's the right thing to do right now, because what you're trying to do is keep long-term interest rates down. What you're trying to do is help the federal government stimulate the economy and support the economy at as cheap a price as possible in terms of long-term interest rates. The irony in all of this, of course, is I'd be willing to put some money on the other side of them actually keeping rates that low in 2023, because when you get to 2023, if the economy has fully recovered or almost fully recovered, the idea that you're going to be able to keep rates that low with an inflation rate that's already above 2%, I think is unreasonable. And I think what you'll see is long-term rates back up, and the Federal Reserve will gradually have to give into that. So at some stage, in some way, they're trying to convince the market they're going to be dovish forever. But I think when the economy is recovered, they're going to have to change expectations about where monetary policy is going.
Mona, they've had a hard time getting inflation to where they've ever wanted it, it seems to me. I'd like to put back on that chart of gold and get your reaction to whether an above 2% inflation rate is achievable in an economy like this one. If so, how soon? And what are the implications, if any, for gold?
Yeah, you know, look, I think over the last 5 to even 10-year period, we've only gotten above 2% a handful of times. So inflation generally has remained below the Fed's 2% core PCE target since the last crisis. And as we're going through this crisis, very unlikely that we get close to that 2% range until we reach a more normal level of activity. Now, keep in mind, this lower for longer in an environment where perhaps 2021 we do get a recovery, not only here in the US, but globally, could prove to be quite strong for risk assets. So, you know, when you have rates this low and GDP growth potentially plus 5%, earnings growth, thus far estimates are calling for plus 25%. Really, investors could be pushed out the risk spectrum. That's a supportive backdrop for risk assets broadly, including equities. Gold, as you mentioned, really does tend to follow the path of the dollar. So you've seen this inverse relationship hold up nicely. A weaker dollar has led to more supportive gold prices. If that dollar trend continues, we think gold can hold up as well. Generally, we remain favorable on gold, given what central banks globally are doing, keeping rates low, in some cases negative around the world. That's also a good backdrop for gold, but also broadly risk assets. So something to keep in mind as we head to the next 12 to 18 months in particular.
And markets are largely hanging on to their gains that we saw going into the Fed decision. The Dow's about 200 points. Let's get back to Steve Leisman for some more color here. Steve?
Yeah, I want to sort of buttress the conversation that David Kelly was having, which is how much metal would the Federal Reserve have when the when the economy moves towards the goals that they set out. First of all, I want to make the following thing. If you look at the inflation outlook, the Fed actually never forecasts that it's going to meet its goal of inflation above 2%, at least not for a single year. The inflation run is 1.2, 1.7, 1.8. And it gets to the 2% goal in 2023. So over this 4-year time period where the Fed now says it's aiming for above 2% inflation, the average forecast never actually gets there. That's one thing. David Kelly asked this question about what the Fed would do as the unemployment rate came down. Well, it does have unemployment at 4%. This is the forecast, by the way. This is not a policy statement. This is the average of separate forecasts from the 17 members. It does have unemployment at 4% in 2023. Does the Fed hold the line at 0.1% on the funds rate with a 4% unemployment rate? That would certainly be a major, major test of this idea of average inflation targeting here.
And Steve, I think that's a really interesting point. If I could just quickly bounce that off our guests. David, let me go to you. What Steve just said is that even with the Fed saying their policy is now aimed at an inflation number above target, the markets don't really believe it. It's not even clear the Fed believes it's going to get there. I mean, so how much does this whole framework change matter if people don't really think we're going to have sustained inflation?
I don't think we truly appreciate just how much things have changed over the last year. I mean, up until this point, throughout the entire recovery from the great financial crisis, we were trying to get there just through lower interest rates alone. And frankly, low long-term interest rates aren't going to stimulate anything. But now what we're doing is essentially monetizing the debt. The Federal Reserve has already lent the federal government over $2 trillion this year. It's lending it another $1 trillion at a running rate here. And regardless of who wins the next election, you could have deficits of between $1.5 and $2 trillion over the next 2 years after this fiscal year. If you've got that kind of fiscal stimulus and the government's able to do it essentially for free because the Federal Reserve is lending them money, that is very stimulative. I mean, I think it's very important to recognize we've moved from the sort of bow and arrow of low long-term interest rates to the bazooka of debt monetization. That is very powerful stuff. And I think people will be surprised at the ability of this fiscal stimulus powered by monetary ease to actually generate stronger growth and higher inflation. I think that will happen in 2022 and 2023.
There's the 10-year, which is still sitting under 0.7%. So again, it all comes down to the markets not pricing that in, but plenty of people saying that it could absolutely be one outcome here. Bob Pisani is also standing by with more on the market's reaction to this decision so far, Bob. And as we've often seen, the press conference can move things more than the statement.
Yes, and we've had the usual up and down. It's been fairly modest. So far this week, we've had a very normal, what is called a Fed drift. This is the tendency for the markets to move upward going in the couple days prior to the Fed meeting to move up. It's up about 1.5%, and that's fairly typical of a Fed drift in the last few days. We started the meeting at 34.10 on the S&P. We went as high as 34.16. I think that several people messaged me they like the modest upgrade to the economy, down 3.7 on the GDP estimate from down 6.7. That's a modest upgrade to the economic outlook. I think traders like that. Purchasing additional assets, always kind of like that. Some people have differences of opinion. Most of the market didn't move, though. We moved after that initial move up 5 or 6 points. We're back down essentially where we started at 2 p.m. Eastern time. Bank stocks continuing to do nothing. No real steepening in the yield curve that's helping them out. I think overall, traders got pretty much what they wanted, except for that, what some people are saying, a modest upgrade to the economy. Guys, back to you.
Bob, let's also talk about this IPO today, Snowflake. Would you connect its performance, I mean, the kind of monstrous performance of these software names this year, the flood of them hitting the market, to the liquidity in general that we're seeing because of the Fed? I mean, are people drawing kind of a line directly from one to the other?
No, I would say that the majority of the influence that we're seeing is because every company in America has to upgrade its software to deal with the fact that the country is moving more online. Every single company that has an online presence needs to do that. And the companies we're seeing coming, and the ones this week and the next couple of weeks, they all address particular niches in the market. They help companies, they help individuals who are on the websites manage them better. They do group management better, project software management better. They're all niche players that are out there that help improve the overall market. I just want to say something about Snowflake, if we can put it up intraday. It's not 120 that matters. People are looking at 120. Everyone bought, the open was 245, and this is traded between 232 and $319. That is an extraordinary range. So there was trading in the 230s. People who bought at 245 were underwater. So that, you want to watch the 245 number, not 120. This had better close above 245, or a lot of people are going to be shaking their heads. And this is the problem when you get these gigantic pop-ups, huge expectations. But if you got an allocation last night at 120, you're an institutional player, and you're at 250, 260, and you have the option to sell, that's a pretty tempting offer for a lot of people, and some people are taking it. By the way, Kelly, it's traded 28 million shares. That's the float in an hour and a half. That's extraordinary. Normally, it's a good IPO if you trade 100% of the float after a full day. In an hour and a half, this has traded the full float, almost 28 million shares. Kelly?
It's a monster. It is a monster. Bob, thank you so much, Bob Pisani. Rick Santelli is also standing by for us, looking at the reaction across the bond market. And Rick, this is where push comes to shove, and even the smallest sensitivity about inflation should be showing up here, and yet the market remains unimpressed.
That's because we haven't seen inflation yet. But I think that if we do and when we do, the market isn't going to be nearly as blasé as many think. Right now, it's easy to talk about no or little inflation. Twos, they were a whisker under 14 basis points. They're still there. Tens were 666, pretty much still there. And if we look at 30-year bonds around 141, fixed income markets haven't moved much. The dollar index may be a little bit higher, but I certainly do want to weigh in on this conventional wisdom that they're advertising something, and oh my goodness, this is so important. It's never happened before. 2008 to 2015, 7 years. Credit crisis, 7 years before we normalize rates from 0 to 25 to the first rate hike by Janet Yellen in December of 2015, because the economy was truly dented. How we come out of COVID, if there's a vaccine, nobody knows. To think that the Fed could keep rates for at this level for 3 years if the economy started to really cook in grease, and we don't know how that's going to be. They're already bringing their numbers down on unemployment down to 7%. It was, 9 or 10%. Their GDP loss figures are getting smaller and smaller. At the end of the day, we don't know how COVID's going to end, and we should end it there because policy will change once we get on the other side of COVID. Tyler, back to you.
Excellent point, Rick Santelli. Thank you. Let me come back to you, John Bellows, if I might, with your thoughts on what this Fed has just said basically to equity investors. And it would seem to me that you don't bet against the Fed, and the Fed is saying, we got your back for the next 4 years, 3 years.
Look, I'm going to say I'm going to say this with a little bit of nervousness because it's hard to take the other side of Rick Santelli, but I'm going to take the other side. I think the reason that the Fed did it today was precisely to tell you what the policy will be even after COVID. And the policy will be easy. The policy will be at 0. And I think the Fed went out of their way to speed up the announcement. They did not wait for the all clear. They did not wait for everything to be clear at the outcome. Instead, they're telling you now. They're telling you now what the policy is going to be after COVID, and it's going to be easy. And the reason it's going to be easy is because they need to get inflation back up. They need to address this unevenness in the recovery. They have a broad and inclusive labor market goal, and that's going to require easy policy. So I think the Fed did a little bit more than expected today. I think they brought forward their announcement. A lot of people expected them to wait and see how things played out. But they said, we're going to give you clarity right now. We're going to tell you what the policy is going to be. And again, I take the other side of Rick Santelli with a little bit of trepidation, but I do think they told you what the policy is going to be.
That's okay. You won't be the first. You won't be the first, John. That's all right. Mona, last word to you. Sum it up for us.
Yeah, look, I think this is a case of don't fight the Fed. We have low rates now, at least through 2021, probably through 2022 as well, until we get a real tried and true recovery, real signs of inflation picking up. In that backdrop, in this low rate environment, the TINA effect comes front and center. There is no alternative. That means areas like equities, parts of the credit markets, even gold, as we mentioned earlier, all could be supported over the next few months, few quarters. Keep in mind, we do have some periods of volatility ahead of us. Of course, we're getting through an election period, potentially contested election period, but those are walls of worry that the market will climb and perhaps even tactical opportunities. So I'll leave it at that.
Mm-hmm. All right, thanks to our panel. David is going to stick around for some final thoughts. Mona and John, thank you very much. It was nothing you said. We're not dismissing you. We love you. So come back next time. We'll see you next time. Thank you very much. We're about 13 minutes away from the press conference from Fed Chair Jay Powell. As we get you set for that, we will talk to a former Fed governor about the big problem he thinks the Fed faces right now. Stay with us.
Welcome back. The Dow and the S&P are hanging on to their gains and, in fact, moving higher after the Fed just left rates unchanged and indicated rate hikes won't really be an issue until 2024. The Dow's up 288 points right now. The S&P's up 21. Even the NASDAQ has turned positive. It's up about 20 points. It was down around 40 going into this. Let's talk about this all with Frederick Mishkin. He is a former Federal Reserve Board governor. Rick, who joins us for an interview. It's great to have you back. Can you hear me all right?
I can hear you just fine.
Okay, great. I wanted to ask you about the dissents. We had two of them today. One from Kaplan, the other from Neil Kashkari. So perhaps one on the hawkish side, one on the dovish side. But we've come out of a series of unanimous moves by the Fed. What does that dissension tell you?
Well, it tells you that there's some disagreement, obviously, that they're not absolutely clear on where they're going. In a sense, there has been a shift, and the key thing is Jay Powell's Jackson Hole speech, which is a whole new strategy for the Federal Reserve, which I very much welcome. It's actually something I've advocated, this so-called average inflation targeting. And I think they're trying to sort out exactly what that means, and maybe this is an indication that they haven't quite sorted it out yet.
What does average inflation targeting mean to you?
So here's the key. One of the big problems you have when you're in a situation where interest rates are so low and you have a need for much more expansionary policy is that the Federal Reserve is hamstrung because they've already gotten the federal funds rate down to zero, which they did in March, and you can't do anything more. You're basically at what we call the effective lower bound. You can't go much below zero. So the question is, how do you make sure that your people understand you want to be very stimulative? And one way to do it is to indicate that when you've had inflation lower than your target for a period of time, which is, of course, what has happened, lower than the 2% target, then, in fact, you want to indicate that for a short period of time, you actually want to shoot for a little bit above that, because it's not just that you want inflation to be 2%, you want it to be average to be 2%. And that's really key. And I think it's a very sensible strategy. What it means is when you have things that have been bad in the past, you now care about them.
Sure.
The old way of doing things was bygones versus bygones are bygones. Whatever's happened in the past, you don't worry. Now we're saying that because things have been weak in the past, we actually have to be even more expansionary in the future and keep interest rates low for longer periods.
That's fine. And maybe we can show this chart that Steve Leisman has prepared from the documents that were just released. But Rick, if that's all the case and the Fed wants to overshoot a little bit and all that, why doesn't it think it actually can? I mean, they don't believe themselves to think that they're going to get a higher than 2% inflation for years.
This is the big problem, and that there are several issues. One is that we found that we used to think, and the theory tells us, that if you just create expectations that you're going to do more, it'll help. But in fact, it's actually very interesting. We look at the case of Japan, that they've actually changed their monetary policy in major ways, starting in 2012 with Abenomics, and it really didn't affect expectations very much. That's a challenge for the Fed. The issue, I think, here is that you got to do what you got to do. You do the best you can. But if you notice, many Fed officials have kept on talking about the fact that the federal government needs to do something. That in a situation like this, that the monetary policy is not going to be as effective. We're at this lower bound, that we had big negative shocks. This is when you need fiscal policy to kick in. And of course, we know that there's been a lot of fighting around Congress. They just can't get a stimulus bill passed. So the bottom line is central banks need to do what they need to do. That's still very important, but it may not be enough. And this is clearly a situation like that.
So where does that leave us then if you're basically saying, the Fed really needs fiscal policy to take the baton here and it may or may not? Do you believe that their quantitative easing, especially if they do more of it, is causing distortions in the economy, or that it's concentrated in asset prices, that it's not making its way into the real economy? Or do you just think it all needs to take some more time to play out?
No, I think it does work, but the problem is, for example, it's very effective in affecting financial markets. The stock market is clearly much stronger than it otherwise would be because of Fed actions. In fact, stock market's near the highs that it had before the coronavirus. That's actually important. The problem is that doesn't mean it has enough effect on the real economy. And so this is the difficulty that central banks face. They're not all powerful. People think that central banks can do everything. They can't. They can affect asset prices, but then the question is, the effect on asset prices, is it enough to actually get the economy moving the way you want it to get moving? We saw this happen during the financial crisis. The Fed did a lot of things that were very, very positive, but in fact, we had a very, very slow recovery. what the Fed can do that's really important is it can prevent a financial panic and a financial crisis.
Yeah.
And that's exactly what they did in March. That was hugely important. Great that they did it. Great that they did it as quickly as they did. In fact, they had a sort of war games, which were showing them how to do it from the last crisis. But once you do that, then you basically, your power is limited. And you have to recognize that and do what's right, but recognize that you may need more, and you may need help in other parts of government policy.
Yeah, well, and interesting just a juxtaposition, we're showing a lot of the bank shares are up today. I mean, they were up going into this, they remain up. So that's one mechanism from kind of financial markets to the real economy, at least. Frederick Mishkin, thanks as always for your time, sir. We appreciate it.
My pleasure.
Former governor of the Federal Reserve. And in just a few moments, Ty, we'll head over to Jay Powell.
Yeah, that's right. He will begin his news conference at roughly half past the hour. It's 25 past right now. He'll explain his decision to leave interest rates unchanged and target inflation slightly above the 2% number that they've talked about for years. We will take you to that press conference. It will be virtual right after this short break. Let's spend a couple of minutes more with David Kelly as we wait for Fed Chairman Powell to begin his press conference. And David, I warn you, we may have to interrupt, but I know you understand.
Sure.
You know, one of the things that was interesting in Mr. Mishkin's comments there was the idea that the Fed, through its monetary policy and its asset purchases, can be extremely effective in boosting asset prices. Higher asset prices help people who have assets. It doesn't do much, right, David, for people who don't have assets, and that leaves fiscal policy as the way to reach them. Am I incorrect or correct about that?
No, you're absolutely correct. And I think we're turning the page into a new chapter here in monetary policy, because after the election, particularly if we have either a Republican sweep or a Democratic sweep, I expect fiscal policy to go all out expansionary. You know, I think we've got a temporary block on stimulus because of politics right now. I think that's going to go away. And if you've got a very expansionary fiscal policy, then that can help the average person and help the economy overall. So I think you'll see that. The real problem for the Federal Reserve, though, is to what extent they want to enable that forever, because there is no limit to what Washington will ultimately spend if the Federal Reserve won't act as some sort of block on them. And if the Federal Reserve commits to keep long-term rates low forever, then we will get bigger and bigger budget deficits. So I think another interesting thing is they've said they're going to keep the federal funds rate low until they see inflation 2%, but they haven't committed to QE for that long. And so what you could see is the Federal Reserve taper bond purchases before they raise short-term rates. If you get that, you could see a steepening of the yield curve. So I think there's some interesting implications for investors in that. But overall, I think we're going to see a lot of fiscal over the next few years being financed by a very dovish Fed.
Yeah, and the Fed, right, exactly. The Fed is financing the borrowing that the federal government is doing, correct? So it's really one pocket subsidizing the other pocket, I suppose is the way I would put it.
Yeah, and it's a dangerous game because it's darn close to what you call debt monetization, where the federal government basically runs the Federal Reserve, and of course, you know that is the road to inflation in the long run.
Sorry
so
to jump in.
It's not a good road to be on.
Chair Powell is taking the podium. Here he is delivering his press conference after their decision today.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide some relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the Federal Open Market Committee and I made some important changes to our policy statement, including an update to our guidance for the likely path of our policy interest rate. Guided by our new statement on longer-run goals and monetary policy strategy that we announced a few weeks ago, these changes clarify our strong commitment over a longer time horizon. Before describing today's policy actions, let me briefly review recent economic developments. Economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interactions, household spending looks to have recovered about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Activity in the housing sector has returned to its level at the beginning of the year, and we are starting to see signs of an improvement in business investment. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, roughly half of the 22 million jobs that were lost in March and April have been regained as many people return to work. The unemployment rate declined over the past 4 months, but remains elevated at 8.4% as of August. Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 7.6% at the end of this year, 5.5% next year, and 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. For some goods, including food, supply constraints have led to notably higher prices, adding to the burden for those struggling with lost income. More broadly, however, weaker demand, especially in sectors that have been most affected by the pandemic, has held down consumer prices. And overall, inflation is running well below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.7% next year and reaches 2% in 2023. As the economy began its recovery, COVID-19 cases, hospitalizations, and deaths also rose. The reimposition of some social distancing restrictions, as well as more cautious behavior by many individuals, have succeeded in slowing the spread of the virus. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on our success in keeping the virus in check. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. The path forward will also depend on the policy actions taken across all parts of the government to provide relief and to support the recovery for as long as needed. The Federal Reserve's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We remain committed to using our full range of tools to support the economy in this challenging time. The changes we made in today's policy statement reflect our strategy to achieve our dual mandate goals by seeking to eliminate shortfalls from maximum employment and achieve inflation that averages 2% over time, as we articulated in our statement on longer-run goals and monetary policy strategy. We view maximum employment as a broad-based and inclusive goal and do not see a high level of employment as posing a policy concern unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. And we believe that achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at our longer-run 2% objective. In turn, well-anchored inflation expectations enhance our ability to meet both our employment and inflation objectives, particularly in the new normal, in which interest rates are closer to their effective lower bound, even in good times. Hence, as we say in our statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take. Of course, as we note in our policy statement, we would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating the damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances such as those we find ourselves in today. These programs serve as a backstop to key credit markets and appear to have restored the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. As I've emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Finally, I would like to take a moment to recognize the passing of our friend and colleague, Thomas Laubach. His outstanding analysis and advice have been indispensable to the FOMC and have played a key role in the policy decisions that will define this era of the Federal Reserve. He will be remembered for his intellect, but also for his kindness, his equanimity, and his dedication to achieving our mission on behalf of the American people. We will miss him. Thank you. I'll now be glad to take your questions.
Thank you. Nick Timrose.
Good afternoon, Chair Powell. Nick Timrose from the Wall Street Journal. You've been very clear about the committee's intentions on rates, not even thinking about raising rates, and today showing low rates even as unemployment falls to 4% and inflation rises to 2%. My question is about asset purchases. Does the guidance today apply to the current asset purchase pace? Are there any macroeconomic conditions under which you would favor increasing the monthly pace of Treasury and MBS purchases? And under what conditions would a decrease in the monthly pace of purchases be appropriate? Thank you.
So we say in our post-meeting statement that we'll continue to increase our securities holdings at least at the current pace over coming months to sustain smooth market functioning and help foster accommodative financial conditions. That latter part is an updating of our guidance to reflect what I've been saying in these press conferences for some time and what other central banks have acknowledged, which is that the purchases are fostering accommodative financial conditions as well. That amounts to roughly $80 billion a month of treasuries and $40 billion net per month for MBS. So we do think that these purchases have been effective in restoring orderly market conditions and have supported the flow of credit to households and businesses, including by fostering more accommodative financial conditions, which of course we think is a good thing. So in terms of going forward, I would just say this. There are various ways and margins that we can adjust our tools going forward, and we'll continue to monitor developments, and we're prepared to adjust our plans as appropriate.
If I could follow up, I suppose the question I have is why give guidance on one policy tool but not give guidance on the other policy tool when the Fed has talked about those two policy tools working together?
So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity. Now we're buying 120 billion in securities per month across the Treasury curve. That's also adding to accommodation. We do have the flexibility to adjust that tool and the rate tool and other tools as well. But as for right now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
Thank you. Gina?
Hi, Chair Powell. Thank you for questions. Gina Smollett, New York Times. I was wondering, you beefed up your language on financial stability in the long-run statement that you unveiled with your Jackson Hole speech last month. I'm wondering if you could kind of walk us through how you think about financial stability concerns as a factor in guiding future rate increases. Would financial stability concerns on their own be enough to merit changes in the Fed funds rate, or would they have to come in conjunction with an overheating on inflation or some sort of dramatic drop in the unemployment rate? If you could just sort of give us an outline of your thinking there, please.
So what we said in our statement on longer run goals and monetary policy strategy was that the committee's policy decisions reflect its longer run goals, its medium term outlook, and its assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So that's what we said about financial stability. And today we said that we'd be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. But you asked specifically about financial stability. One thing I would say is that monetary policy should not be the first line of defense, is not the first line of defense on financial stability. We look to more appropriate tools in the first instance as a first line of defense, and those would be regulation, supervision, high capital, high liquidity, stress testing, all of those things, macroprudential tools, all of those things are really the first line of defense on financial stability. But we always leave open the idea that we will not ignore those kinds of risks and other kinds of risks more broadly that could impede the attainment of our goals in setting monetary policy. So that's really how we think about it. But principally that, other tools are the front line, as I mentioned.
But just to follow up quickly, if other tools aren't forthcoming, would financial stability concerns in and of themselves be enough to warrant a rate hike?
So it's, what we said in the longer run, in our consensus statement is that we, policy decisions reflect the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So the test would be, does a majority of the committee feel that that monetary policy is triggering that, and that would be the test. And it's not something that we've done. We do monitor financial stability concerns, of course, intensely and regularly. We try to use our other tools on them, but we do keep them in mind as we think about monetary policy.
Thank you. Steve Leisman.
Mr. Chairman, I wonder if you could help me understand how the projections of the committee line up with the goals of the committee. You've now altered the projections to the statement to aim for inflation above 2%. But when I look at the SCP, I don't see the committee believe a single year in the next 4 years that you are ever above 2%. In fact, for each year, you are below it until 2023 was the first time that you actually hit 2%. So do you think, are you confident? Does this suggest the committee is not confident that not only can it not hit its 2% goal, but that now it can't hit its goal of being above 2%?
Not at all. You also don't see people by and large lifting off or raising interest rates above zero. I guess there are 4 exceptions out of a committee of 17 during the forecast period. So we don't reach 2%, but we get very close to it in the forecast. We reach 2%. I guess the median is 2% at the end of 2023. So what the guidance says. It says that we expect that the current setting of our rates will be what we expect that it will be appropriate until such time as we reach 2% inflation, that we feel that labor market conditions are consistent with our assessment of maximum employment, and that we're on track to achieve moderate inflation moderately above. So that's the test. So I don't think there's any conflict between those two because, the way they're set up, the projections don't show the out years. You ask about confidence, and I would say that this very strong, very powerful guidance shows both our confidence and our determination. It shows our confidence that we can reach this goal and our determination to do so.
I'm sorry if I could just follow up about being simplistic about this, but why wouldn't, if the committee was confident that it could reach its new goal of aiming for inflation above 2%, why wouldn't one of those years at least show inflation being above 2% on the median forecast?
Because we think, looking at everything we know about inflation dynamics in the United States and around the world over recent decades, we expect it will take some time. We expect that the economy will recover quickly now, but that pace will slow as people go back to work, and we'll still have an area of the economy, a big area of the economy that struggles. There'll be slack in the economy. The economy will be below maximum employment, below full demand, and that will tend to put downward pressure on inflation. So we think that once we get up closer to maximum employment, we think that inflation will come back generally. And I mean, that's sort of what happened during the last long expansion. It's a slow process, but there is a process there. Inflation does move up over time. We do expect that will continue today, and we expect that our guidance is powerful and will help that outcome. We think that effectively saying that policy will remain highly accommodative until the economy is very far along in its recovery should provide strong support for the economy and get us there sooner rather than later.
Thank you.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. I wanted to ask if you anticipate a slowing in the pace of the recovery if there is not another stimulus package, and specifically if there are particular holes still remaining in the economy that you think could be helped by more aid from Congress. Thanks very much.
Sure. So first, if you look at the summary of economic projections that my colleagues and I filed for this meeting, what you'll see is an expectation that the recovery will continue, that it will continue at a reasonable pace through 2021, 22, and 23. We do expect that pace will slow just because you would expect that the pace would be fastest right at the beginning of the recovery, because you had such a sharp decline. You would expect that the third quarter should be the fastest gains, and that after that the pace should slow down to a more normal pace. So we do expect that. In terms of fiscal policy, you asked about fiscal policy. So, one thing, I guess I would start by saying that the initial response from fiscal authorities was rapid, it was forceful, and pretty effective. And we're seeing the results of that today in the income and household spending data, in the labor market data, in the construction data, in the data for business equipment spending, and the fact that businesses are staying in business, and the pace of defaults and things like that has really slowed. So there's been a really positive effect. That said, my sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. But I would just say there are still roughly 11 million people still out of work due to the pandemic, and a good part of those people were working in industries that are likely to struggle. Those people may need additional support as they try to find their way and through what will be a difficult time for them. We've also got struggling small businesses, especially those in the business of facing directly to the public. And we have state and local governments dealing with a drop in revenue. At the same time, spending has gone up, much of it related to the pandemic and economic effects. So again, I would say the fiscal support has been essential in the good progress we see now. And finally, I'll note that just about all, the overwhelming majority of private forecasters who project an ongoing recovery are assuming there will be a substantial additional fiscal support.
Thank you. Mike Derby.
Taking a question. Should we expect any further evolutions in forward guidance, say maybe an adoption of something akin to the Evans rule that we had a few years ago, or is there something else that the Fed might be considering in the future?
Well, so we think that the forward guidance we adopted today is appropriate and, as I mentioned, powerful. Effectively, what it says is that we will keep policy where it is now, keep the rate policy where it is now, until unemployment reaches the committee's assessments or levels that are, sorry, not unemployment, labor market conditions reach levels that are consistent with the committee's assessments of maximum employment, until inflation reaches 2% and until it's on track to go above 2% moderately for some time. So that's very strong forward guidance, and we think that will be durable guidance that will provide significant support to the economy in coming years. So that's really our thinking on forward guidance on rates.
Thank you. Howard Schneider.
Thanks, Chair Bell, for doing this. Sort of follow up on Mike's question there. Since you described this guidance as durable, you've set up a three-part test here for rate hikes. Levels consistent with assessments of maximum employment. Inflation has risen to 2%, and you're on track to moderately exceed 2% for some time. Each of these have modifiers, and I wonder if you'd explain them a little bit more. How do we pin down assessments of maximum employment? When you say that inflation has risen to 2%, does that mean 2% for a day, a month, 6 months? And when you say on track to moderately exceed, how should we define moderately, and how should we define for some time?
So, as you know, maximum employment is not something that can be reduced to a number the way inflation can. It's a broad range of factors. It really always has been, and really substantial number of factors that we've indicated we would look at. So it's broader labor conditions consistent with our committee's assessment of maximum employment. So that would certainly mean low unemployment. It would mean high labor force participation. It would mean wages. It would be a whole range of things. And we're not looking at a rule. We're looking at a judgmental assessment, which I think we'll be very transparent about as we go forward. In terms of inflation, this is a committee that is both confident and committed to and determined to reach our goals. And the idea that we would look for the quickest way out it's just not who we are. It's not that there's no message of that here. We would not be looking for 1 month of 2% inflation. We said return to achieve 2% inflation. Okay, so just understand that we're strongly committed to achieving our goals and the overshoot. So that should tell you about that. In terms of so what does moderate means? It means not large. It means not very high above 2%. It means moderate. I think that's a fairly well understood word. In terms of for a time, what it means is not permanently and not for a sustained period. We're resisting the urge to try to create some sort of a rule or a formula here, and I think the public will understand pretty well what we want. It's actually pretty straightforward. We want to achieve inflation that averages 2% over time. And if we do that, inflation expectations will be right at 2%, and that'll help us achieve 2% inflation over time and avoid the situation where the central bank loses its ability to support the economy.
Thank you. James Politi.
Thanks for taking the question. James Politi with the Financial Times. Do you consider today's enhanced forward guidance to have actual accommodation to the U.S. economy from a monetary perspective, and sort of delivered further support for the economy, or is it just a tweak to your existing policy stance? And in terms of fiscal support, do you assume in your own projections, not just private forecasters, that additional fiscal support will be forthcoming, or do you expect a weaker growth or a larger contraction rather this year if no fiscal support is forthcoming?
So in terms of the effects, so I think what we've done is more or less aligned with the consensus statement today. So it's in line with what might have been expected. As I mentioned, I think over time it will provide very powerful support for this economy as we move forward. In a sense, it's consistent with expectations. So I'm not looking for a big reaction right now, but I think over time, again, guidance that we expect to retain the current stance until the economy has moved very far toward our goals is a strong and powerful thing. And I think that will be supportive of the economy over time. In terms of additional fiscal support, I guess your question is what would happen if, people have different assessments, and different participants in the FOMC made different assessments on their own. I think broadly, though, there is an expectation among private forecasters and among FOMC participants that there will be some further fiscal action, and there does seem to be an appetite on the part of all the relevant players to doing something. The question is how much and when. And so I would just say that if, and it's very hard to say, that so far the economy has proven resilient to the lapsing of the CARES Act unemployment, enhanced unemployment benefits. But there's certainly a risk, though, that that those who are unemployed appear to have saved some of those benefits, and they'll now spend them, and that as the months pass, if there's no follow-up on that, if there isn't additional support, and there isn't a job for some of those people who are from industries where it's going to be very hard to find new work, then that will start to show up in economic activity. It'll also show up in things like evictions and foreclosures and things that will scar and damage the economy. So that's a downside risk. So I think the real question is when and how much and what will be the contents. And no one has any certainty around that. But broadly speaking, if we don't get that, then there would certainly be downside risks certainly through the channel I mentioned.
Thank you. Anakin, CNN.
Thanks for taking my question. Chairman Powell, given the recent update to the policy framework and repeated calls for this in the Fed Listens event, is the Fed open to other measures of the economy, such as income inequality and affordability of housing?
So we monitor everything we think is important in the U.S. economy, and in a broad sense, all of it goes into thinking about monetary policy. You mentioned inequality, so disparities in income and in financial well-being by various demographic and racial categories, something we monitor carefully. Inequality, which I would point to, it's a multifaceted thing, but I would point to the relative stagnation of incomes for people at the lower end of the income spectrum, and also lower mobility. So those are things that hold back our economy. They are. The thing is, we don't really have the tools to address those. We have interest rates and bank supervision and financial stability policy and things like that, but we can't get at those things through our tools. When we lower the federal funds rate, that supports the economy across a broad range of people and activities, but we don't have the ability to target particular groups. Notwithstanding that, we do talk about it because these are important features of our economy, and I think those distributional issues are issues that are really for our elected officials. And I would say I take them seriously as holding back our economy. The productive capacity of the economy is limited when not everyone has the opportunity, has the educational background, and the health care and all the things that you need to be an active participant in our workforce. So I think we can, if we want to have the highest potential output and the best output for our economy, we need that prosperity to be very broadly spread in the longer run. And I would just say the Fed, we can talk about those things a lot, and when we think about maximum employment in particular, we do look at individual groups. So the high unemployment in a particular racial group like African Americans, when we would look at that as we think about whether we're really at maximum employment. We would look at that along with a lot of other data. So the answer is we do look at all those things and do what we can with our tools, but ultimately these are issues for elected representatives.
Thank you. Edward Lawrence.
Yeah, thank you, Chairman Powell, for the question. I just wanted some clarity here. At what point do you think it's prudent to shift the bond purchases from market stability, as you had said, from the shorter term maturities to more longer term, more stimulus related?
So we think that our asset purchases are doing both those things today. We think clearly there's been great progress in terms of market function. If you remember, early in the spring, when the acute phase of the pandemic hit, market function was very low, and it's improved rapidly, and in many respects is in a good place now. We also, though, think that these asset purchases, which total $120 billion a month, which is much larger than for example, the last asset purchase program during the global financial crisis and the recovery therefrom. We think that that's also providing accommodative financial conditions and supporting growth, and we think that's fine. We're also aware that there are ways we can adjust that, to do various things, make it smaller, make it larger, and also target different sectors of the curve. And we're going to continue to monitor developments, and we're prepared to adjust our plans as appropriate.
Thank you. Victoria. Victoria Guida.
Hi, thanks for taking my question. I wanted to ask about a couple of things. First of all, if we don't get a vaccine until well into next year, what does that mean for the economy? And then somewhat related, I was wondering if you could provide any more detail about the stress scenarios that you all are going to release for the big banks and whether that is going to be another full-blown stress test, whether we're going to publicly see those results and what it might mean for bank payouts.
Great. So on the first one, what's happening is basically we're learning to live with, right now, we're learning to live with COVID, which still spreads. And we're learning to engage in economic activity. All of this recovery that we've seen is in a context where, where people are still at risk of catching it. And yet we're able to resume lots and lots of economic activities. And that involves, as I mentioned, I think the more social distancing we can preserve as we go back into the workforce, wearing masks, keeping our distance, that kind of thing, the better we'll be able to get economic activity back up close to where it was. I do think, though, there are areas of the economy that are just going to really struggle until we have a vaccine that's in wide usage and is widely trusted. And those are the ones where people were getting really close together. I also think testing, to the extent you have cheap and rapid testing, you can do a lot with that in the workforce. You can build confidence in the workforce if you have very regular testing. It doesn't cost very much, and you get the results really quickly. If you do that, you'll be able to open a lot of workforces, particularly in cities where the overall case numbers are quite low. And that will help a lot. So I think we're going to be finding lots and lots of ways to get out towards, as far as we can. There's always going to be that for some time. There's going to be certain activities that will be hard to resume. So I think that's the only way I can say it. And I think trying to, when we make a forecast, we make assessments about that. But it's really hard to say. There's no template here. There's no there's no experience with this. So frankly, for the last 60 days or so, the economy's recovered faster than expected. And that may continue or not. We just don't know. And I think we should do those things that we control to make sure that we can recover as quickly as possible. And the main thing, again, is wearing a mask and keeping your distance while you're in the workforce. That's something we can all do that will limit the spread and let people go back to work, avoid major outbreaks and things like that. In terms of the stress test, so I really don't have any, we're getting ready quite soon to be making announcements and saying things publicly. There's not much I can say with you. Nothing really that I can say that's on that today. I don't have anything for you.
Thank you. Chris Condon.
Thank you, Michelle. Good afternoon, Chairman Powell. You have emphasized many times, including today, that the Fed can only lend and not spend, and sometimes the latter is what's really needed. But to the extent that a $600 billion lending program for small and mid-sized companies could help, what exactly is wrong with the design or function of the Main Street lending program, which has purchased just, I think, $1.4 billion in loans so far? Eric Rosengren at the Boston Fed said recently that Congress should clarify how much risk it wants the program to take. But Congress has already appropriated substantial funds for the 13.3 programs. And these are funds that are explicitly designed to absorb losses. Meanwhile, my colleagues who cover the banking sector say they're being told by commercial banks that the Treasury Department is advising them to target zero losses in Main Street program loans. So, if I may, why is it that the Federal Reserve, the Congress, and the Treasury apparently cannot agree on a loss tolerance that should be applied to the Main Street lending program in a way that would allow badly needed credit to reach these companies? Thank you.
Sure. So a couple things about Main Street. It reaches the whole nation. It's got more than half of the banking industry assets signed up among the banks that are part of it. And it's making loans. The number's more like, it's close to $2 billion now. So the numbers are going up. Banks are joining, borrowers are coming. And it's significant. It's relatively small now, but it can scale up in response to economic conditions, should that be appropriate. If you look out in the lending world, surveys generally find that firms are not citing credit constraints as a top problem, and that is a lot of PPP, bank credit lines, and syndicated loans. There's a lot of credit being let out there. But you're right. We are looking at some things. We're looking at some lenders are concerned about the underwriting expectations. So banks are going to, their approach is likely to be that they're going to underwrite this loan roughly the same as they underwrite any loan. They're keeping part of it. And, what we want to do is make sure that that they know that they should take the payment deferrals and other things in place, and also that it's really a facility for companies or borrowers that don't have access to regular way borrowing now. Otherwise, why would we need Main Street? So that's what we're working on, and we'll be doing we'll be making some changes in that respect. I saw what President Rosengren said. I can't really comment directly on that. I just would say that this is 13.3. If you look at the law under Section 13.3, it's very clear that we are to make loans only to solvent borrowers, and the CARES Act is quite specific in keeping all of the terms of Section 13.3 in effect, including the requirement that we, gather good evidence that the borrower is solvent. This law was amended in Dodd-Frank, and the idea was to make it challenging and put hurdles in place before we made loans. What at the time the thinking was to banks. So now we're using that same law for smaller business borrowers, and it's not a perfect fit. And I would also just say for many borrowers, they're in a situation where their business is still relatively shut down, and they won't be able to service a loan, and so they may need more fiscal support. Having said that, we're continuing to work to improve Main Street, to make it more broadly available, make it available pretty much to any company that needs it and that can service a loan.
Could you just very briefly address the reports that the Treasury is advising banks to target zero losses? Is that appropriate?
I can't say. I don't know about that. I haven't heard those reports. Again, if you think about it, we're going to have to go through the banking system to do this. We're not going to have 100,000 or 1 million loan officers working for the Fed and the Treasury. So we're going to go through the banking system, and the banks like to make good loans. That's what they do. They're trained to make good loans. So you should expect that we expect that they will do some underwriting. We also want them to take some risk, obviously, because that was the point of it. And the question is, how do you dial that in? It's not an easy thing to do, and we're getting some loans made, and we're hopeful that we'll clarify this, and that credit will continue to flow.
Thank you. Chris Rugaber.
Hi, thanks for taking my question. Chair Powell, you've talked a couple of times about parts of the economy that may not recover as fast as we've seen so far. Presumably you're referring to airlines, hotels, other sections, parts of the economy that rely on close contact. How are you thinking about that in terms of its overall impact? Is that sector large enough to say keep unemployment above, far above your maximum goals? Are you expecting that to come back with a vaccine, or are a lot of those folks going to have to find, new jobs and new industries? And should we expect the Fed will keep rates at zero until all of that reallocation is done? Thank you.
Yeah, we can't be we can't be really sure we know the answers to those questions, but I would say the likely path is that the expansion will continue, and it's, as I said, it's well along, and it'll move most easily through the parts of the economy. It'll still take some time, but the parts of the economy that weren't exactly directly affected, that didn't involve getting people in large groups together to feed them, to fly them around, to put them in hotels, do entertainment, things like that. Those are going to be the places that are very challenging. So there will also be the places that are affected that way, and that's going to be challenging for some time. It just is, and we don't really know how long that will be. It's millions of people. As I mentioned, we had 11 million, something like 11 million people in the payroll survey have gone back to work out of 22 million who lost their jobs in March and April. So that's half of them. So 11 million, particularly if the pace of returning to work slows down, it's going to leave a large group of people, and it'll be very meaningful from a macroeconomic standpoint. And our commitment is not to forget those people. As I mentioned, we want, the sense of our forward guidance is that policy will remain, as we've said, highly accommodative until the expansion is well along, really very close to our goals. And even after, if we do lift off, we will keep policy accommodative until we actually have a moderate overshoot of inflation for some time. So those are powerful commitments that we think will support the full recovery, including those people, as long as it takes.
Thank you. Mike McKee?
Mr. Chairman, Michael McKee from Bloomberg Radio and Television. Based on what you were just saying about keeping policy accommodated for a very long time into the recovery, lower for longer, as far out as 3 years in your latest projections, is that basically it for the Fed? In other words, since interest rates are your main tool, the things you can do would push down on interest rates. But is it the case now that the only additional stimulus that can come to the economy is from the fiscal side?
Well, no, I wouldn't. I certainly would not say that we're out of ammo. Not at all. So, first of all, we do have lots of tools. We've got the lending tools, we've got the balance sheet, and we've got further forward guidance. So there's still plenty more that we can do. We do think that our rate policy stance is an appropriate one to support the economy. We think it's powerful, and as I mentioned, this is the kind of guidance that will provide support for the economy over time. The idea being that policy will remain highly accommodative until the recovery is well along, really very close to our goals, and then will remain accommodative even after we lift off. So I think that's a really strong place for rate policy to be. But again, we have the other margins that we can still use. So no, certainly we're not out of ammo.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So of course we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago and more when the Fed first started doing QE. And I would say if you look at the long experience of the 10-year, 8-month expansion, the longest in our recorded history, it included an awful lot of quantitative easing and low rates for 7 years. And I would say it was notable for the lack of the emergence of a whole division of the Fed to focus on financial stability. We look at it from every perspective. The FOMC gets briefed on a quarterly basis. At the board here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is a particularly tight one. So, but again, we won't be just assuming that. We'll be checking carefully as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
Thank you. Don Lee.
Chair Powell, I'd like to ask you about the labor market. As you know, in August, there were about 30 million persons claiming unemployment benefits. Yet the BLS jobs report for August showed about 13.5 million unemployed, only about 6 million more than before the pandemic. I wonder how you reconcile that and what you think the actual labor market conditions are.
So, I think the overall picture, take a step back from this, the overall picture is clear, and that is that the labor market has been recovering, but that it's a long way from maximum employment. I think that's the bottom line on it. So within that, though, take claims in particular, the number of claims, the quantity of claims, and frankly, the fact that PUA claims are new, the pandemic unemployment assistance claims, that's a new system that had to be set up. The actual counting of the claims is volatile, and it's very difficult to take much signal about the particular level. So, because people were setting those systems up, and when they got them set up, they counted them all at once and things like that. I think, though, what you've seen is that the level of initial claims has declined very sharply from the very high levels of March and April, and is now at a lower level, continues either to be flat or gradually decline. It's worth noting, and that's good, it's worth noting that level is maybe 5 times the level of what claims were. Claims were around 200,000. Now they're 900,000 in that range weekly for initial claims. So that just tells you the labor market has improved, but it's a long way from maximum employment, and it will be some time getting back there. I think that's the best way to think about it. In many parts of the economy, there's just a lot of disruption, and it's really hard to say precisely where we are. I'll give you another example. We say unemployment's 8.4%, but if you count those who are misidentified as employed when they're actually unemployed, and you add back some part of the participation number. So if you had a job and you were in the labor force in February and you lost it because of the pandemic, some of you are now being reported as out of the labor force. But I would more look at those people as unemployed. If you add those back, the level of unemployment is probably 3% higher. On the other hand, by that metric, the unemployment rate would have been in the 20s in April. So the improvement has been quite substantial under any measurement, but the level is still quite high.
Well, if I could follow up, is it the Fed's aim to get back to 3.5% or even lower?
Yes, absolutely. I can't be precise about a particular number, but let me just say there was a lot to like about 3.5% unemployment. It's not a magic number. No one would say that number is the touchstone, or that is, maximum employment. I would just say you ask about 3.5%. A 3.5% unemployment rate showed, gains being shared very widely across the income spectrum. In fact, going more to people at the bottom end of the spectrum. It showed labor force participation coming up above many estimates of its trend, as people who'd been out of the labor force were being pulled into a tight job market. There's a lot to like about a tight job market, particularly in a world where we didn't see inflation. So yes, we'd love to get back to that. I mean, I would say we would like to get back, rather than to a particular number, we'd like to get back to a strong labor market where wages are moving up, where people can find work, where labor force participation is holding up nicely. That's what we really love to get back to. Now, of course, we need inflation to perform in line with our framework. But the good news is we think we can have quite low unemployment without raising troubling inflation.
Thank you. Nancy Marshall-Genzer.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to follow up on the wealth gap issue. I know you were saying that you have limited tools, but are there things that you can do possibly in the area of research and maybe expand your research on racial economic gaps?
You know, we do, we are gifted with a substantial group of researchers who really cover the waterfront, and we do a significant amount of research on racial disparities across multiple variables, including wealth, as you ask about. So we do that, and we also, remember, we have our Division of Consumer and Community Affairs, which is present in communities around the country, and the reserve banks all have very active community affairs groups. They're present in communities around the country. So it wasn't just the Fed Listens events. It's more just over a long period of time, we are in contact with people in those communities to understand their experience of the economy. We serve all Americans, and we know that, and we're going to use our tools to reflect that fact. So the answer is yes, we do quite a bit of research, and I suppose we could do more, but we really do a lot, and we contribute to those fields and those assessments of the state of the economy. And we do that not just because it's interesting and important, but because it's important for the economy and important for our mandate. We are assigned maximum employment. Now, what does that mean? As I mentioned earlier, it doesn't mean a particular headline unemployment number. What it means is maximum employment. So, you know, we look at that in many, many different variables, and we ask ourselves whether those variables or those labor market conditions are consistent with our assessments of what would constitute maximum employment. And that would include all of the things that we're talking about.
Thank you. Greg Robb.
Hi, Greg Robb from Market Watch. Thanks for this. I want to go back to the new forward guidance that you have. And you say that it's powerful, but you've already had two dissenting voters on it. And I was wondering if there's other people who argued against it. And what do you say to the two who dissented? It looks like President Kashkari wanted a simpler forward guidance, and President Kaplan thought that the current guidance you have was fine for now. So, like, how did you argue back on those arguments? Thank you.
I wouldn't. I don't want to comment particularly on the two dissenters, but they dissented from, of course, different perspectives, and that should be clear. That's they're sort of on two sides of the discussion. But I would say this, I am blessed with having a committee of highly thoughtful people who bring diverse life experiences and diverse careers, and of course, diverse views to our work. And I wouldn't have it any other way. I wouldn't. So I would just say in our discussions the last couple of days, the whole committee, everybody on the committee, is very supportive of the statement on longer run goals and monetary policy strategy and what's in there. Very, very broad support, unanimous support for that. Everyone sees the changes in the underlying economy and sees in their own way the need to address those, and including the changes we made to the employment mandate and to inflation, so that we're now flexible average inflation targeting. Of course, there would be, we're the first major central bank to adopt this framework. There's no cookbook, and this is the first guidance under our new framework. So, of course, there would be a wide range of views, and you would expect that, and it's actually a healthy thing. So I welcome that discussion. I would also say this, this is all about credibility, and we understand perfectly that we have to earn credibility. This facility, this framework we have to support it with our actions, and I think today is a very good first step in doing that. It is strong, powerful guidance. It ties in very nicely with the statement of longer run goals and monetary policy strategy. We had quite a robust discussion. There are different ideas on how to do this, but That's just the way it is when you have a diverse group of highly thoughtful and effective people, and so I'm pleased with where it came out.
Thank you. Hannah Lang.
Hi, Chair Powell. Thanks so much for my question. I wanted to ask about commercial real estate. I know you had mentioned before, weren't sure if there was a way the Fed could support CRE borrowers, but I was just wondering if you've had any other continuing discussions on that, and if there's any potential way that the Fed could step in that area.
So thank you for that question. We've actually spent quite a bit of time on this, as Secretary Mnuchin, I think, mentioned the other day. And I'll say just a couple of things. First, our facilities are essentially always, they have to be under the law, broad-based and not so much targeting any single sector. Also, it's important to remember that CRE, commercial real estate, benefits from several of our existing facilities. So the TALF takes commercial mortgage-backed securities and SBA commercial real estate deals, and the New York Fed purchases agency CMBSs directly. In addition, I would say Main Street helps businesses pay their rent. So we're helping real estate, in a number of other ways, commercial real estate. Also, CMBS issuance has resumed. Spreads have tightened on CMBS. There are a couple of issues. One is just that commercial properties with CMBS loans often have covenants, uniformly, I think, have covenants that forbid them to take on more debt. So you have a situation, where you, without a legal change or some kind of an innovation that defies discovery so far, you have a hard time providing mass relief with regard to real estate that's in commercial mortgage-backed securities. So we're still working on it. We're still looking. I would say it may be that further support for commercial real estate will require further action from Congress.
For the last question, we'll go to Brian Chung.
Hi, Chairman Powell. So it seems like a lot of the new inflation framework is about shaping inflation expectations, but the average American that might be watching this might be confused as to why the Fed is overshooting inflation. So what's your explanation to Main Street, to average people, what the Fed is trying to do here, and what the outcome would be for those on Main Street? Thanks.
It's a very, very important question, and I actually spoke about that in my Jackson Hole remarks a couple of weeks ago. It's not intuitive to people. It is intuitive that high inflation is a bad thing. It's less intuitive that inflation can be too low. And the way I would explain it is that inflation that's too low will mean that interest rates are lower. There's an expectation of future inflation that's built into every interest rate, right? And to the extent inflation gets lower and lower and lower, interest rates get lower and lower, and then the Fed will have less room to cut rates to support the economy. And this isn't some idle, academic theory. This is what's happening all over the world. If you look at many, many large jurisdictions around the world, you are seeing that phenomenon. So we want inflation to be, 2%, and we want it to average 2%. So if inflation averages 2%, the public will expect that, and that'll be what's built into interest rates. And that's all we want. So we're not looking to have high inflation. We just want inflation to average 2%. And that means that, in a downturn these days, what happens is inflation, as has happened now, it moves down well below 2%. And that means that we've said we would like to see, and we will conduct policies so that inflation moves for some time moderately above 2%. So these won't be large overshoots, and they won't be permanent, but to help anchor inflation expectations at 2%. So yes, it's a challenging concept for a lot of people, but nonetheless, the economic importance of it is large. And those are the people we're serving, and we serve them best if we can actually achieve average 2% inflation, we believe, and that's why we changed our framework.
Thank you very
Thanks
much.
very much. Fed Chair Jerome Powell wrapping up his press conference there. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. Let's get straight to the market reaction to that, because we actually hit the session high and the session low within the space of 45 minutes during that press conference. There's the S&P 500 view, 1.4% turnaround in the space of 47 minutes there. We were up 1%. We're now down 0.3%. Started to rally really when the statement came out as opposed to the press conference. Clear commitment, rock bottom interest rates until late 2023, which is the first time the Fed considers the possibility of inflation getting above 2%, but sold off during the course of the press conference, albeit led by tech, the less interest rate sensitive sector. And a quick look at yields, Sarah, which started to move up more during the press conference and in reaction to the statement a little bit later than the market moved up, and also pulled back a little bit, 0.69 on the 10-year, so not a huge move there for interest rates, but some serious market volatility within the session and during that press conference, Sarah.
Dollar stronger as well. I'm not sure what was new about this. The Fed and Jay Powell just found another way to say that interest rates are going to stay low for a very long time, with the forecast that 4 members of the Fed say by 2023 they'll look at raising interest rates, but a majority of the Fed members expect rates to stay zero throughout that year, 2023. And they now expect the GDP to contract 3.7% in 2020 this year, a little bit better than expected. We've got a lot to talk about. We've got an all-star panel standing by to break down all the latest headlines from the Fed and Chair Powell. And in just a bit, we're going to get reaction from former Fed Vice Chairman Stanley Fischer. Used to be number 2 under Janet Yellen. Plus, the CEO of EY, Ernst & Young, will join us to discuss new research on how ESG investing will impact bottom lines for businesses and what they're focused on.
Looking forward to those interviews. Let's get straight, though, to our Fed panel and get reaction from that press conference. Sarah Bloom-Raskin, former Federal Reserve Governor and Deputy Treasury Secretary. Seth Carpenter, Chief Economist at UBS. Paul McCulley, former Chief Economist at PIMCO and a CNBC contributor and senior markets commentator at CNBC. Mike Santoli, all with us. Sarah Bloom-Raskin, I'll come to you first of all. I mean, clearly, as Sarah said, finding a new way to commit to not raising rates for any moment in the foreseeable future. But I guess that kind of recommitment to that point, perhaps less new or having less market impact than it did over the last couple of times.
Exactly right. So, there was a challenge here for the Fed because it has to take that new framework and it has to figure out how to move it into guidance and how to communicate it. And you could see, particularly in the press conference, you could see Chairman Powell having to explain it several different ways for the questioners. And he also took 2 dissents here, which I think he also probably had wished he hadn't, although he sort of wrapped it up in a nice bow, saying he loves having this diversity of thought. But you saw here an extensive markup, really, in terms of what the statement looks like, even though the action itself wasn't really news. There was quite a bit of a new red ink here on the FOMC statement, and then you saw really a first attempt to start to explain to the public what this means and exactly the extent to which there's going to be real change. And I think as a first attempt, it was okay, but you did see really a sense of a little bit of struggle here on what this means. And of course, there were 2 dissents.
Sarah, the other thing that stood out to me is clearly his support for more fiscal action. My sense is more fiscal support is likely needed. Again, he's said that before, but we are embroiled in this stalemate, basically, in Washington for more fiscal support. And I guess the question is, how much more can he do if Congress isn't going to do anything?
Exactly. And, I've heard him before give a more full-throated plea, really, for fiscal support. And you didn't hear it coming through as much this time. A sense of resignation, a little bit. I think that, this is just, this is going to be what it is. The Fed may be the only game in town in terms of monetary and economic support going forward. And I think you did hear him say he thought there might be a deal. That is not certainly the consensus view at the moment. There is no deal in sight, as we as we sit here, and yet he clearly indicates that that he would prefer there to be some kind of economic support. But you didn't hear him really push for it the way he has in the past. And of course, this puts the Fed in a particularly tough decision, because if the Fed is the only game in town and there is no future fiscal support, you're going to see the Fed continue to struggle with the need for more targeted assistance. And as you know, the Fed, that is not the strong point, the targeted assistance. That's really the fiscal set of tools. And so he's going to continue to get questions about the, the particular emergency lending facilities and why there isn't the amount of take-up that, that they would like to see with it. And he's going to continue, the Fed's going to continue to struggle with that if there is no future fiscal support.
Mike Santoli, market clearly turned around significantly in the last hour. Is that because of this press conference?
It's not clearly it was, to be honest. It was mostly tech, as you mentioned, leading the way down. It seemed almost as if this sort of ongoing pullback consolidation was a little bit on pause, waiting for the Fed. I do think that perhaps Chair Powell's repeated emphasis or mention of the assumption in many private sector economists' forecasts of more fiscal help kind of being pretty central to the outlook, maybe has some wear and tear on the market expectations, but also just the lack of really all that much of an incremental short-term thrust in terms of these policy moves. So I see the market action a little more kind of having been on pause up to and during the statement period, as opposed to reacting to it.
Yeah, tech was soft all day long, and now we're seeing the lows on the NASDAQ there, more than 1.2% lower. Stay with us, everyone. Definitely want to get to you guys, but we want to also bring in Steve Leisman. He was part of that virtual news conference with the Fed chair, asked a question about the guidance. Steve, what were your main takeaways?
Well, first, go back to the statement, Sarah, and it is an historic day where the Federal Reserve now specifically says in its statement that it's aiming for inflation above 2%. So it took what was in that long-term strategy stuff we talked about in August, now makes it part of policy. Some of the other keys leaving rates unchanged, but more than that, forecasting, as Wilf said at the top of the show, of zero funds rate into 2023, raising the GDP forecast so the recovery is going a little faster and lowering the unemployment rate outlook. But Sarah Bloom Raskin talked about, I think she was being kind about the kind of way that the chair struggled to really explain this new policy. And he struggled a little bit when I asked him why the forecasts don't show the Fed succeeding at its goal of hitting 2%, above 2% inflation.
It's a slow process, but there is a process there. Inflation does move up over time. We do expect that will continue today, and we expect that our guidance is powerful and will help that outcome. We think that effectively saying that policy will remain highly accommodative until the economy is very far along in its recovery should provide strong support for the economy and get us there sooner rather than later.
Two implications of that, guys. One is that the Fed has to be doing more now if it's aiming for above 2% inflation, or two, it's going to be at zero for a lot longer than 4 years to achieve above 2% inflation. Sarah?
Steve Leisman. Steve, thank you very much. Seth Carpenter, we'll bring you in on that question. What's your inflation forecast? How does it stack up with the Fed's, and what does it mean for Fed policy?
Yeah, no, I think the Fed's in a tough position. That you saw from their forecast today that the median has inflation just getting to 2%, not overshooting, but just to 2% in 2023. I think that's probably just slightly optimistic. But going back to what Steve said about why don't they have more of an overshoot in their forecast, I think it's an interesting contrast that they don't have an overshoot in their forecast, and yet Chair Powell kept insisting that they're not out of tools. They have plenty of other tools. The statement they made was so powerful. I wonder why there was such a need to stress just how powerful it was if they're not actually able to achieve that overshoot in their forecast.
Paul McCulley, another part that stood out for me was when Chair Powell said, if you look back over the last 10, 11 years, one thing is notable, that there was not a financial market bubble created by loose policy. Was there a little bit of complacency in that statement?
More of a resignation, I think, than complacency, in that his focus and the FOMC's focus is squarely on the real economy, and they're willing to accept that Wall Street is going to be giddy and they don't think that it's out of line right now. But I think he was really trying to communicate that they're focused on Main Street. And in general, I think I would give Chair Powell much higher marks than Steve did in communicating the new framework. And the one nugget that I would pound the table about is that when he was laying out the sequence of things that would be necessary in order to hike rates, he put full employment before inflation at 2%. So inflation going above 2% would not be a trigger. That the primary objective, the number one objective, is full employment or maximum employment and 2%. So I think that's the nugget that was really powerful from the standpoint of forward guidance, and was also the signal to the fiscal authority to get on with it and get some serious fiscal expansion.
Thank you all for joining us as we watch this market give up some of its gains. Dow still positive, up 116 points or so. NASDAQ deep in the red. Sarah Bloom-Raskin, Seth Carpenter, Paul McCulley on a Fed day, our special Fed panel. Thank you. Still ahead, we've got much more on today's Fed decision, what it means for your money. We're going to talk to former Fed Vice Chairman Stanley Fischer. And after the break, fresh comments from bank executives, and it's only September, but snowflakes are already making an appearance on Wall Street. Those stories and more when we take you inside the market zone. Minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day, as always. And today, we've got Ritholtz Wealth Management CEO Josh Brown here as well. Welcome back, Josh. We'll kick it off with the broader market. Stocks losing some steam here into the close. The Dow is up 369. at one point session highs earlier during the news conference, and then proceeded to give up most of its gains, ticking higher again here into the close, up 159 points. Josh, do you demand to come on during Fed days so you can explain what the market is doing after Powell? And if so, explain it.
It's in my contract, Sarah. I don't know that we want to. I don't know that we want to take this late day swoon as anything more than just buyers and sellers matching prices. I really don't think there's any message in it specifically. But big picture, what I want you to focus on is this pervasive idea we've had that the entirety of the market rally has been pushed up by a group of 5 or 8 stocks, large cap tech, consumer discretionary. All of those stocks are red today. Nvidia, Netflix, Amazon, go down the whole list. Meanwhile, you have materials breaking out to fresh highs. Home building stocks right now, the ITB names, every single one of them, I went down the list, looks incredible. Technically, they're acting like they're involved in cloud computing. Industrials breaking out. And the REITs look like the World's Fair. So I think you've got so much happening outside of large cap tech that those stocks can have a red day and we can look pretty decent on balance. So that's where my head is at. And I think that's the most important thing for investors to just remember. It is a market of stocks despite how big the big guys have gotten.
Mike, are those cyclicals that Josh just mentioned legitimately rallying based on fundamentals, or is it just purely because they underperformed for so long in recent years and recent months coming into the last little run out?
No, I think they're legitimately rallying because the direction of change is positive in terms of their, increasing earnings projections off of very depressed levels, and also the stocks were down a ton, right? So you saw FedEx numbers last night. Now that's a stock that you had earnings estimates being hacked away at for quarters and quarters on end, and the stock got super cheap. That was an area of the market, the transports, that were in a bear market for 2 years, and they're lifting off of that. So I don't think it's completely a matter of just the fact that the laggards are catching up. It's certainly that in part. There's sort of some dry powder in those parts of the market. But in general, it's much more about, we're kind of riding what the cyclical forces will give us in terms of direction of recovery. It doesn't mean the market's going to get that right and things are going to get great in time to justify every single stock price. But I do think that's what's mostly happening there. And yes, there was this ongoing kind of retrenchment pullback in the large cap tech stocks that just resumed. Look, Apple's down 2% today, and it's nothing to do with Jay Powell. The average stock, the equal weighted S&P is up 0.2%. That's fine. You could make a case perhaps there's no incremental new fresh reason that Powell gave you to get excited about the market, except he told you he's going to keep real interest rates super negative as long as they can see. And that in general should not be bad for the market.
The banks are strong today, and overnight, before today's Fed decision, JP Morgan chairman and CEO joined CNBC in Asia and addressed recent action by the Fed in general, and also addressed government action.
What they didn't want was a global financial crisis in addition to a Great Recession. That's where markets close down and people can't get money. And so they kept the markets open, which benefited everybody. They don't need it right now. They're so wide open that they don't need to be pumping it up anymore. Just let nature take its way. The governments of the world took dramatic, bold, rapid action, fiscal, monetary, the companies, the vaccine companies, et cetera. And I think that's very admirable. Of course, we're going to be finger pointing and yelling and screaming at each other for years about the parts that didn't go well. And it is a little disappointing. We haven't come together in the United States with another round here, because I do think we do need that round.
That was the CNBC Singapore summit there. Banks, as I mentioned, up today, sharply continuing a crazy week of U-turns for the bank share prices. Today at the Barclays conference, Morgan Stanley CFO Jonathan Pruzan said August trading levels have been good, but that Q3 would be a little lower overall than Q2's blowout print. He also talked optimistically about their recent E-Trade acquisition.
We're more excited than we were when we first announced it. I mean, one of the things that we're excited about is just the performance that they've had through this period, right? They've got more clients, they've got record net new assets, record clients, record levels of cash, record activity levels.
Up about 1.7% now, Morgan Stanley. Most of the banks higher today. Mike, the moves today hide the volatility this week overall now. KBW Bank's index up 1.5%, but they've been up and down over the last couple of days. Citigroup remains sharply in the red for the week.
Yeah, I would characterize it as a pretty mild bounce, just given how weak they've been to this point. The immediate response after the Fed statement and during the press conference was that the yield curve did steepen a little bit. Longer-term yields went up a bit. That moderated. So I do think it's still in that sway, and there's no doubt about it that if you're geared toward wealth management, individual stock trading, capital markets, the more you have there, the better you should be doing right now. Even though Interactive Brokers, that one kind of smaller trading-focused retail broker, the stock has not been great, and I think it's mostly because on their balances, they're not really earning anything with rates where they are.
Let's talk about the newest, hottest tech stock on the block, Snowflake. Shares skyrocketing after making its highly anticipated debut on Wall Street today. Leslie Picker with the details. Leslie.
Hey, Sarah, that's right. It's the biggest IPO of the year, the largest software IPO ever. And yet the law of large numbers does not seem to apply here. This stock more than doubling. You can see up 115% on its first day of trading. That comes as mixed news for CEO Frank Slootman as he contends with leaving about $4 billion on the table while investors generate massive paper profits.
As frothy and as it looks today, this is just a hot deal, and we will just have to sort of live with the consequences of that.
Hot deal is an understatement here. Snowflake was valued at $12.4 billion just 7 months ago. Today, it's almost 6 times that size, looking to close upwards of $70 billion in terms of market cap, guys.
That's a wow number. Leslie, thank you. Josh Brown, is this an indication of just how growth-starved investors are in this low interest rate environment, or is this Snowflake in particular a story there of that stock with the Buffett backing?
Yeah, I think there's a lot of different things going on. I think you're exactly right, Sarah. I'd also point out, we've been playing this game with low floats on IPOs for a long time, too. And you even see just general enthusiasm for the sector. But I want to turn everyone's attention to what I think the biggest takeaway is with Snowflake. And it's not Snowflake itself, which the stock price obviously today is a very fun sideshow. But I think the real story here is Berkshire Hathaway. I own the B shares, so I'm biased in what I'm about to tell you. But I think this is important. I think that Berkshire Hathaway is on the verge of undergoing the mother of all re-ratings. And I think the Snowflake involvement, it's tiny. It's $560 million. So it's not going to have a huge impact on Berkshire Hathaway, no matter what the share price does. But the signal, he started buying Amazon last year. Now they're involved in pre-IPO, venture-backed technology companies. They've been involved in other companies that are listed as tech companies, such as Visa and MasterCard. A lot of people don't realize that those are considered tech. But just this idea that Berkshire Hathaway, at a $500 billion market cap, half of that market cap is made up of the Apple stake and cash. So it's just this extraordinary situation where you have a company that everyone now expects to keep making these clumsy, ridiculous 20th century investments like Wells Fargo and Kraft Heinz and the stupid airlines. They're not doing that anymore. They are becoming participants in the 21st century, and nobody is valuing this company as though they could seriously play there. But they have the cash, they have the clout, and Ted and Todd understand that a business like Snowflake doesn't look very different than some of the best investments Buffett ever made. It's this kind of toll booth gateway business. So that is what I think is the big thing here. This Berkshire should be 250 minimum, if not 300 at some point, because they're going to play in some of the most important markets of the new century, and they've got new investment stewards doing that work with Buffett's blessing. So I really think that that's the biggest takeaway from this.
Josh, I have a follow-up on this after the close, which I know we have to go to next.
Great.
Okay, well, we've got just about 2 minutes left in the session. Let's go back to Mike for some market internals. Mike.
Yeah, Sarah, they've softened up a little bit, as you would expect, although if you look at the New York Stock Exchange outside the NASDAQ, still very solidly positive. I mean, look, almost 3-to-1 advancing volume to declining volume. That's obscured by the fact the S&P's down under the weight of the mega cap growth stocks. Also, a little bit of a reopening flavor to the market. If you look at a couple of ETFs here that would track roughly what's going on, that leisure and entertainment ETF tends to pop on days when people think we're closer to going back to normal. And then I like this other ETF that's long online retailers and short in-store physical retail, and that obviously is weaker today. So that's an undertone that's not evident in the big cap indexes. Then the volatility index, we always try to revisit this, been very sticky up here in the 25, 26 area. That's something that I don't think has changed. It's still, it's kind of declined from the recent highs in the 30s, but it still shows you that we're on alert here in a weak seasonal period heading into an election, even if the market as an index level is holding up okay.
Just under 1 minute left. S&P 500 down 0.4%. It peaked up about 1% about an hour or so, hour and a half ago. The Dow still higher by 71 points, but had been as high as 370 points, but it's in the green. Unlike the NASDAQ and the S&P, NASDAQ comp down 1.2%. Energy, the comfortably strongest performing sector within the S&P, up nearly 4% as oil is up nearly 5%. Banks doing well, as we discussed. KBW Bank's up 1.7%, though only up 1.4% for the week. It's been up and down all over the place, the banks this week. Tech, the worst sector, followed by communication services, followed by consumer discretionary, all of those names that we've been mentioning that are suffering: Tesla, Apple, Amazon, etc. We've got the dollar that's just a little bit higher, 0.2% following the Fed decision. Yields a little bit higher as well, 0.69 on the 10-year. At the close, S&P down nearly 0.5% near the session lows. The Dow also near a session low, only up by 0.15%. NASDAQ Composite down 1.25%, Sarah.
That'll be the first down day for the S&P in the last 4. Welcome, everyone, to Closing Bell. I'm Sarah Eisen here with Wilfred Frost and Mike Santoli, CNBC Senior Markets Commentator. Take a look at how stocks finished up the day. Post-Fed, post-Jay Powell news conference, the Dow closed up 38 points, so lost pretty much all of its gains. It was up 369 at the highs of the day following the Fed decision, and then sort of gave up its gains into the close. The S&P 500 closed the day lower, 0.5%. Technology was a big part of the story. It was one of the biggest losing groups, along with communication services and consumer discretionary, all the red-hot groups lately. You did see strength, though, as Wilfred noted, from energy, financials, and industrials. The NASDAQ down 1.25%, which was a rough day for the tech-heavy index, but only its worst day since September 10th. So September continuing to be bumpy here for the tech trade. The Russell 2000 index of small caps, interestingly, went up today, 1%. So what we saw is a real rotation, selling some of the winners in technology and into small caps and value, which have underperformed this market for this year. A lot to talk about. Coming up, we're going to ask former Federal Reserve Vice Chairman Stanley Fischer about the outlook for the economy and whether Congress is putting this recovery at risk by not passing another round of coronavirus relief. Joining us first, though, to talk about the market today, Josh Brown from Ritholtz Wealth Management is still with us, joining the conversation. Sarah Malik from Nuveen and Michelle Meyer from Bank of America Global Research. Welcome to everyone. We've got a lot on our plate, though. First, Mike, I'll turn to you on the action we saw from the stock market, how Fed-related it really was, and some of the rotations there into groups like industrials and financials and small caps.
Yeah, I don't think the Fed was the main driver today, although, it certainly confirmed investors' premise about what Fed policy is going to look like for a very long period of time. Zero interest rates, even up to full employment, even if you get inflation over 2%. That's very supportive, but not necessarily fresh. The story of this month has been people felt overcommitted to large cap tech after that August rally. They've been for sale. I think that you had a little bit of a suspension of that pullback ahead of the Fed. It resumed afterward. Also, the overall market, you've actually closed lower than we opened most of the days this month. So it just seems as if there's just a little bit of a kind of a sell the rallies mode right here. It's still a kind of a mild correction and maybe has to play out a little bit longer. But I'm not really seeing anything in there that really says there's economic stress because, as you point out, those other parts of the market, the cyclicals, have held up okay. Credit seems fine. It's just a matter of whether, in fact, you have risk appetites across the board in these huge, successful tech stocks that are going to be able to support these levels for any longer.
Michelle, the Fed chair seems pretty confident that we're not going to see any inflation for at least 3 years and no move in rates because of that. Do you think he could be surprised?
I think the inflation story right now is a bit of a time dimension to it. So in the short term, you could see some real inflationary pressure build because of the big increase in durable goods spending, the fact that there are some supply chain issues, some challenges in terms of manufacturing. And that's quite apparent if you look at the recent data with used car prices higher, household appliances, et cetera. But at the end of the day, in the medium term, inflation will ultimately be driven by the amount of slack there is in the labor market, whether or not wages are rising, whether or not inflation expectations are setting higher. And I think the evidence largely points to the idea that, there's more disinflationary tendency. So I do believe that it will take a long time before you achieve this average inflation target, before you actually get inflation to run above.
So, Sarah, what are the market implications of that and this whole new regime where we're watching inflation for an overshoot?
I mean, we actually think, we agree with Michelle, it's going to be a long time until we need to worry about a structural inflation. We think the Fed could overshoot inflation before they react, which is positive. Also, low interest rates until at least 2023 are positive for the markets. And we look at Powell's comments about the economy as actually positive for these growth stocks that rolled over today, because our view is moderate growth. These growth companies are less levered to the economy. We think that they'll continue to recover from here and actually creep higher, because these are very strong companies with strong revenues, margins, and earnings, and they should continue to perform well from here.
Josh, I'm going to pick up on your point about arguing Berkshire Hathaway is about to have a massive breakout because it's relevant for the broader markets. The pushback, of course, to your point just before the close, would be to say, could this not mark the top of the growth run and the start of the value run, when the ultimate value investor finally throws in the towel and makes a pivot?
What's interesting is that Warren Buffett historically has not really been a value investor. He's been a growth at a reasonable price investor. And the quants will tell you that if you break down the way they've done security selection over the years, it looks way more GARP than it looks classic kind of Ben Graham, despite the fact that Graham was Warren Buffett's mentor, and that's very well known. So I think the value investor concept is a little bit of a misnomer. That's number one. Number two, when I talk about a re-rating, I'm not saying that all of a sudden they're going to start treating Berkshire Hathaway like a tech incubator and give it a tech multiple. But come on, this stock's being valued like a utility with no dividend. Or like it's just an insurance company. Apple is paying Berkshire Hathaway $800 million a year in dividends. I don't even think most people realize that. And so if they're going to be a participant in the 21st century, and recent indications tell me that they might want to, that is going to be, in my opinion, a big sentiment shift in the way people value this company. And that could happen really fast. Give you two very quick examples. Apple itself, selling at a multiple of 15 times earnings until the street realized, wait a minute, they subscribe for the phones, they subscribe to Apple Music. This is now a subscription tech business, and they took its multiple up to 40 times earnings. Walmart buys Jet.com in 2016, 4 summers ago. All of a sudden, Walmart's multiple goes from 12 times earnings to 60 times 3 years later. So that is the type of thing that happens once in a generation to certain stocks. And when it does, it's very powerful. So I'm not saying it definitely will. Who knows? But I think it would be appropriate given how much financial flexibility Berkshire has and how interested it appears to be in businesses other than old leather shoes and cans of salt water.
Or Crystal Light, which is made by Kraft Heinz. The point is well taken, Mike. Let's talk about Snowflake, what Josh was talking about, that investment there. Shares surged on their IPO, very hot software company. What do we need to know about this company and the way it's being valued on Wall Street?
Yeah, I mean, so many threads are running through it right now that are kind of prevailing in this market. First of all, there's some willingness to believe that a company can come almost out of nowhere and become indispensable in a hurry in this new world of cloud computing, of this one better mousetrap in software that can completely change things. So that, I think, is basically the baseline belief that's behind the embrace of this company right now. We saw it happen with Shopify, which is, by the way, down 5% today. It went to $100 billion before anybody knew it in market cap. So not to say that justifies what happened with Snowflake, but that's the thinking behind it, that these companies can go from zero to everybody has to own it in no time at all. Now, it also was another one of these IPOs that just took on a life of its own. It became the must-have. I know that CNBC.com said it was the most requested ticker on on our site earlier today. That tells you that the world at large decided this had to be something they had to own. And of course, it gets priced out of the gate at this crazy demanding multiple of any conception of what their revenue could be down the road. So all of a sudden, the bar is amazingly high for this company.
Sarah, what did you make of the Fed decision today, this promise of low rates for 3 years or more? Does that mean avoid bank stocks?
I mean, generally, the Fed decision positive for equities overall with low rates, low inflation, and also supportive of the markets going forward. You know, we're bigger fans of growth stocks. We do think bank stocks have a lot of headwinds here going forward. If we were looking for value companies, we're looking more in areas such as U.S. small caps that are more protected from some of the tariff issues that we're seeing. And we're also going outside of the U.S., looking at an area such as Europe, which can recover quite nicely and has high exposure to cyclical companies. You know, for classic value to work, you want interest rates to be going up, inflation to be increasing, and also see some signs of that stimulus, which unfortunately we're not seeing another package yet. So for that, the classic value areas for us are not of interest right now. You may see some rebound, but you really don't have that catalyst in place beyond somewhat of a reversion to the mean. Beyond that, we don't see the catalyst to take them higher.
Michelle, is it puzzling to you to see a group like transports rally today, 0.7%? I think they're trading near all-time highs. Industrials, financials, energy, really cyclical value groups that have underperformed without a stimulus package on the table. Do you wonder about the sustainability of those trades? How does it shape your forecast with the big unknown over more relief from the government?
Yeah, so I mean, I think there's certainly the reaction to the fact that the recovery thus far has been faster. I mean, we've retraced about half of the decline as a result of COVID, and that happened at a rate that was quicker than many had anticipated. And I think markets are reflecting that, you know, with some of these movements here. But the next stage of the cycle, the rest of that healing process, I think will be more challenging because you don't have as easy of a bounce. And you have to figure out how to recover in industries that are really tied to the COVID shock. So how do you think about the long-term trajectory for services spending, particularly those in entertainment or in travel? Presumably it's going to be more challenging. So I think it's really important to think about this in two stages. The first stage was the bounce off the bottom. It was impressive. It was faster than anticipated. The second stage, it will presumably take a bit longer. I think the recovery is ongoing, but there will be more speed bumps. And one of, I think, the speed bumps that are here right now, which Sarah, you just mentioned, is the fiscal stimulus. If we don't see another round of fiscal stimulus in near term, which it increasingly looks like we won't, then that does create some challenges for the ability of the consumer to continue to spend at the same pace that they had been spending. It doesn't stop the recovery, but it could create some stumbling blocks.
We will leave it there. Guys, thank you all for joining us to talk about the markets today. Josh Brown, Sarah Malik, and Michelle Meyer. Up next, we will ask former Federal Reserve Vice Chairman Stanley Fischer whether central banks around the world are doing enough to support the global economy during the coronavirus pandemic and just what other options they have if they want to do more. We're back in 90 seconds. The major averages closing mixed for the day. The Nasdaq fell 1.25%, but small caps rallied. The Dow closed up 36 points, and groups like financials and industrials actually stood out. The Fed wrapping up its two-day meeting in the last hour. Fed Chair Jay Powell emphasizing the importance of fiscal policy and helping the economy bounce back during his news conference. Listen.
Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve.
Joining us for more analysis is Stanley Fischer, the former Federal Reserve Vice Chairman. Welcome back. It's great to have you. My big takeaway of the news conference from Jay Powell was it's going to take a while. Everything's going to take a while. The bounce back in the economy and the return to higher interest rates. What was your impression?
Well, you hit that right where it needed to be. That was a massive slow adjustment, but still, we've come back much faster so far than expected 6 months ago. And there are areas where things are coming along very well. There's a big item that we didn't talk about, or that the panel didn't talk about, and that is what's happening with the vaccine. And is it really just about to happen shortly before the election, which seems unlikely, but who knows? And that could make a big difference in terms of getting more workers into the labor force, and that would help getting employment up considerably. So that's another factor that's out there, unknown to us, how that dynamic is going to move, but it could be a big dynamic.
What about this new posture on inflation, saying that they're going to let it run hot, and Powell's going to great lengths today to say this is a powerful new tool of forward guidance. Does that resonate with you? Do you think that's going to be effective?
Well, it could be, but the problem is we've been trying to get inflation up for ages. I don't think there was a shortage of attempts to get inflation up over the last 10 years or so, but nobody has done that in the United States now for 10 years. And presumably we've been told that there's going to be stronger efforts to keep interest rates lower. And then there's, of course, the other element, which Chairman Powell has been emphasizing, and I think most macroeconomists would have been emphasizing, which is we've got to do something to get fiscal policy, or at least aggregate demand, up, because we can't do it all through monetary policy. And that still remains clear. And Chairman Powell emphasized that point very well. And we'll have to see whether there is a workable compromise that could happen within a couple of weeks. It doesn't seem like it now. We'll just have to watch and hope that we get another source of demand out of fiscal policy. And we're still waiting to see if that happens.
To that point, clearly we have had some fiscal stimulus this year. Well, we've had a lot of fiscal stimulus, but of course there was weaker demand out there. And it's seemingly likely we would get more fiscal stimulus even if it doesn't come before the election. To that point, is there a chance that inflation risks are underpriced at the moment?
Well, there's a chance. I don't think it's a particularly high one. And if anything, we're seeing the inflation rate looking a little slower than at least I had thought it would be. And we'll have to watch and see whether the amount of money put into the system and the amount of demand put into